Goeiemiddag almal. Baie welkom by die 5de Nasie in Gesprek reeks vir die week. Ons sien uit na 'n baie interessante gesprek met 'n interessante paneel, mense in die finansieringsagtergrond, en ons hoop julle geniet dit hier saam met ons vandag. My naam is Elmarie Joint van Senwes en ons bied dit graag vir u aan saam met ons ander borge, Nedbank, Engen, John Deere en Bayer. Geniet dit saam met ons. Dankie, en ons gaan net eers 'n kort scensetter wys om vir julle meer oor die onderwerp uit te wys. Dankie.
Financing is key to establishing, expanding and sustaining farming operations and underlying infrastructure. It's therefore critical that agricultural finance models keep up with the changing landscape. There have been several recent developments such as digital finance systems, data-based record keeping, impact investing, climate-smart agriculture, blockchain technology and innovative crop insurance, to name a few.
Yes, of course, artificial intelligence has been around for over 60 years, and there have been many false dawns. And when you interact with it, it really feels like you're interacting with another smart human being. So this shows that AI, artificial intelligence, is at a tipping point. And yes, I recently announced 2 new ventures, obviously with partners, and the one uses artificial intelligence to invest in New York on the NASDAQ Stock Exchange, while the other is a private equity fund where we're hoping to raise $200 million, and then we're going to invest in companies that employ artificial intelligence in their business, because that's where we think the biggest changes are going to happen in the economy, when people bring AI inside to their businesses.
In many ways, South Africa's agri-businesses and financiers have already changed their approach to financing, shifting from product-centric to farmer-centric, from short-term to long-term goals, from being risk-averse to managing risks, and from top-down to a bottom-up approach, having a relational approach instead of a transactional approach.
Leveraging of the Agricultural and Agro-Processing Master Plan, essentially the roadmap for what South Africa's agricultural sector wants to achieve, one certainly needs to look at alternative finance models, both in terms of the amount of state finance and investment that's needed in infrastructure and some of the enabling requirements. Commercial finance is needed within the context of increasing volatility, increasing climate volatility, and increasing input costs. Agbiz has been intimately involved in the development of the blended finance mechanism to bridge that gap between the state-funded finance versus commercial financing, the so-called middle, to assist commercializing farmers.
Finance is critical for the growth of South Africa's agricultural sector. And in many of our communities, we still have weak land governance. And in conditions like that, we do need the government's intervention to de-risk the private sector so they can continue to support new players in such areas, which is why blended finance is such an important instrument, and it should be spread across all of the agricultural role players.
Integrating developing farmers into the system is crucial if we want to ensure the security and stable environment of rural communities, grow the sector, create a healthy economy and ensure food security.
The world is moving at a faster pace into the future. One of the key drivers of this movement is the technological advancement. This technology in the agricultural sector involves the use of finances, the use of machinery, and the use of what is called precision agriculture. However, this technological advancement needs to be extended to the developing agriculture, such as the ones that we have in South Africa, the sub-Saharan Africa, as well as the rest of the developing world. If we do not include this technological advancement in enhancing access to finance and access to inputs and markets, we risk leaving them behind. We risk food security. We're risking development of the rest of the population that depends on the agricultural sector.
Financing in agriculture is very important. If we take grain production, for example, 80% of all producers make use of production finance to be able to produce in the season. The whole financing environment is also changing, where we always had collateral and a big emphasis on security for the collateral. There is a big shift towards more in terms of the efficiency of the farm, the sustainability of the farm, and also the jockey of the farm. And what we see in the future regarding that is A lot more emphasis is going to be on the sustainable use of soils, data information that helps you to put more efficiency, technology in terms of precision agriculture, which at the end of the day is all used to make your risk on the farm as low as possible, and that would be the indicators that's assisting you with your credit applications.
Are we in need of a mindset change? And where do we start?
Good afternoon, ladies and gentlemen, and good afternoon to the panel. I think it is a critical discussion simply because without the liquidity being provided by the financial institutions, the agriculture sector, nor any other sector in the economy will be able to drive, to move. But I want to start with a principal point that I think people do not always appreciate. And that is, remember, a bank which is at the core of the financial infrastructure. A bank's first responsibility is towards that person that deposits his or hers money with the bank. So I get my paycheck on the 25th, goes into the bank. I expect the bank to make sure that if I want to buy anything, that funds is available. So therefore the bank's first responsibility is towards the depositor, the person whose pension fund goes into the bank, the worker whose salary goes into the bank, anybody with a deposit in the bank. Now, the bank then pays me an interest on that. So that interest is a cost to the bank. The bank needs to make sure I can get my money and pays me an interest rate on that. So the bank then takes that money and lends it out. Because where are they going to earn the interest from it? They need to lend it out. But that margin, look, it's a bit more complicated because there's capital adequacy and there's liquid facilities. So I'm going to simplify it. The bank then takes that money and lend it out. There's about a 3.5% difference between what they pay and what they earn. But now the bank's got to run its operation, its technology, its staff, its infrastructure in that. That means the bank in the end ends up with 1.5% as a margin. That's what the bank make, 1.5%. So if somebody goes belly up, if somebody doesn't pay its loan, there needs to be 20 or 30 people that actually services the loan to make sure the bank gets its money. So one needs to be careful. A bank's primary responsibility is towards the depositor. That person after whose money the bank is looking. And I think we just need to always keep that in mind. Draw it down to a margin which is then pretty thin. And we need to appreciate that. But let me start off with my panel here. I've got, which is very nice, I've got two bankers in the panel, senior bankers. John Hudson from FNB, from Nedbank. John Hudson is the head of agriculture at Nedbank. Apologies, John. John has actually been supporting this Nation in Conversation for how long, John?
Yeah, well, I think since it started, to be honest.
More than 10 years. So John and Nedbank, thank you very much. You've always been a part of that. And you've always not only contributed as a sponsor, John, but you've contributed on the panels. So thank you very much for joining us, John. The other banker is Aubrey Rautenbach. He's head of agribusiness at ABSA. Aubrey, you are a big player in the agri-finance. So we are going to talk to you a bit about what you are seeing and how you guys are experiencing it. Then next to him is Wikus Grobler. He's the managing director of GrainLink, which is part of Senves, and we're going to talk to you a bit about your position around funding. We've got Antwa van der Westhuizen, managing director, John Deere Financial, Africa and the Middle East. And if you want to see big tractors, just walk down about 30 meters and you'll see the nice big green machines. And John is the guy, or not, John is not the guy, Antwa is the guy that you talk to if you want to finance that big tractor. And then right next to me is Verena Griffiths. She's a partner at Adams & Adams. And we're going to specifically talk to Verena when we get to data and the ownership of data. John, I'm going to start with you. The finance funding sector, banking sector specifically on the funding side, and I want to work it through to agriculture. How have you experienced the changes, John, in the last, let's say, decade?
Yeah, thank you, Theo. Yes, John Hudson from Nedbank. So we'll just get that straight. But it certainly has changed, and I'm probably going to try and explain it in one or two ways and not overcomplicate it, because I think the video did a pretty good job in that. It spoke to some of the changes that have taken place. I think the biggest change, and I've been in agri finance for 30 years, but certainly with Nedbank for the last 12, 13, 14 years, what I have seen is that there's a change or move away from the tangible security, so that's the farm that underpins the lending, to repaymentability. And really that shift is all to do with risk. And while you could have argued we had the farm in the background, in particular if you're doing long-term funding. So if you're looking to do long-term funding, we know in terms of agricultural funding, there's often a lag between the investment and the return. Look at long-term crops or the development needed with a farm. It always takes time for that money to come back in. So while land as security is still vitally important, it is vitally important, especially in terms of longer-term lending, or at least that the person occupying the land has security of tenure. So if you want to match your lending, let's say 10 or 15 years, that you would at least want to have a lease in place or a bond over the fixed property. However, the crux for me is risk, and you were talking about risk, and the other component of that margin is the risk, as you said. People do fail from time to time, is understanding the risk. And really the way I understand risk is that there's financial risk, and that's how much money we lend to the farmer, and can he repay that money? And then the business risk. And really the business risk, I think, is what a huge amount of work has gone into in, say, the last 10 years, is understanding what is driving the business. What are the risk drivers, and what are the mitigants of that risk? So it's really come down to focusing on a business and the ability to repay, and what goes with that repayment ability. So understanding the downturns and the cycles, understanding the sort of management capabilities, understanding the various risk factors. So if you're in export crops, just understanding the exchange rate, for example. So I think that has been a major shift for me. The other point I do want to make, and I'll get to where there's a challenge or a gap, I think, is that the mainstream banks, Nedbank, FNB, ABSA, and Standard, we have focused on commercial agriculture. That's where the information is good. There's normally audited financial statements. There's very clear engagements with our client, very specific around the needs of the customer. So it's no longer a one-size-fits-all approach. We talk to this customer and their specific needs and understand their financial risk and their business risk. So that's where the discussion has got to. What has happened, of course, in terms of combating the cost-price squeeze, is that farmers have increased scale, and we've seen that, and it's still evident. There's a little bit of a stagnation around scale at the moment while people focus on the efficiency, but we've seen continued increase in scale. The other key component is technology. So if you put those two together, that's really how farmers have survived. And as a bank, we've had to, along with farmers adopting technology, and I think they're one of the best adopters of technology, to be honest. And that's why I'm not surprised when farmers are almost at the forefront of adopting technology, and we'll be talking about some of the innovations, around digital technology, etc. Is that as much as the farmers have adopted technology, so have the banks. Okay, so I think our investment into technology, and if you look at Nedbank, we technology first, digital first, and digital. That's a key focus area for us as Nedbankers, and how we adopt technology and how we make our lives easier for our clients is really important. Equally, how we then embrace technology in addressing the risk that I was talking about. And often there, I think one of the changes I've seen in the last year or two is that banks have possibly realized that they are not always the best to understand that risk or to add value to their client. So there's two parts to that, and therefore we're looking to partners to help us with it. And that partnerships are often on a shared sort of risk and reward principle. It's important that both parties, it works for both parties. The ultimate goal, though, is to add value to the client, okay? And whatever that might be. So whether it's irrigation, whether it's sustainability, whether it's technology, whether it's drones, using drones in the counting of cattle or whatever, there's got to be value to the farmer and there's got to be value to the bank, and often the partner can actually deliver that. And it's on the back end as banks is how do we, and this is the exciting point going forward, and I think maybe Aubrey will add to this about how do we use this technology and how do we use this information to manage risk. So it's not just about being, what is the balance sheet? It is important. I'm not saying balance sheet is not important. My credit colleagues will shout me down if I say it's not important. But managing the risk and using technology to manage the risk end to end in the value chain, is so exciting for us. And I think it's how we do that, both as banks, but also how we employ partners to help us on that journey. And the ultimate aim is to ensure sustainability of the financial sector, including financial sustainability. The challenge, of course, is that in the commercial agricultural space, this is pretty well understood. Looking at risk, looking at long-term sustainability is part and parcel of what we do with our clients every single day. How do we ensure that we widen the net to include new era farmers? And that's where I'm also looking to partnerships, because I don't think the banks can do it alone. We are looking to government through blended finance scheme and so on, and that's just to bring down the cost of capital. But we need to look to like-minded partners. So whether it's the John Deere's of this world or Senvest or whoever has the expertise to partner with the bank to ensure that we are providing access to farmers that aren't able to maybe engage their banks on a one-on-one. Because let's face it, if you're going to have a one-on-one relationship with a client, there's got to be some return. It's got to be financially viable for us to cover all those margins and those costs. So how do we do that at scale? And this is where digital is playing a massive role, to now access a much wider market and provide those services to a wider market. So whether it's a technology or access to technology, access to markets, or in fact, more cost-effective funding mechanisms. I think those are what's in the melting pot at the moment.
Well, we are going to spend quite a bit of time on technology and turn the discussion around that. But thanks, John. Aubrey, John noted the value chain and the importance of the whole value chain in terms of delivering not only the products but delivering the food to the table from the farmer. In terms of the financing around the value chain and technology, how do you see that?
Thank you, Theo. Yeah. So I think if I can start close to the banks, you would have picked up in the last couple of years that we always used to call the divisions agriculture, and it's now called agribusiness. So I think that speaks to the value chain. Then I think, the value chain, the role that it plays, it provides, there's a product flow and there's a payment flow. And it generates some information. One of the interesting stories around COVID and panic buying was exactly, where this information flow did not flow properly through. There was enough product, but somewhere in that value chain, the information got misinterpreted, and people panicked and bought stuff that was actually not in a shortage. So I think, the important piece is to go and identify in the value chain the key value chain actor. So that's the guy that makes and oils this value chain. The banks or the financiers are an enabler. They're not part of the value chain. So you find the key value chain actor, and then through that you follow the product and the payments, and you try and de-risk that value chain. So if it's a contract from a corporate buyer, and that gives you the security and the comfort, it helps you with the flow of information, because that key value chain actor's got a vested interest in the commodity. So it's not only fulfilling, and sometimes we misinterpret some of the financial tools like guarantees, that says a guarantee, there's no vested interest with a company. So there's no better way of getting the key value chain actor to have a vested interest, and they make sure that the information flow. On top of that, you can then add a lot of the technology. You can do remote sensing, which tells you a forward view around the crop that's coming. You can gather data from different data sources. As banks, if we're in this mind frame, it's historical financial information and a cash flow projection, but there's this third-party data, that's generated even from a John Deere tractor. There's some data that's generated, and how do you use that data source then, to also make sure that you've got a full view of this value chain, and you can the value chain itself de-risk.
And the key there is to de-risk so that you can price it correctly. If you cannot manage the risk, obviously you can't price it. Because I wonder, before we go to technology and Antoine, in terms of capital, however the source of capital, there is also a question of the allocation of capital. Your view?
Ja, ek dink wat die afgelope 2 jaar in die wêreld gebeur is, kapitaal het ewe skielik skaars geword en kapitaal het verskriklik duur geword. En ek dink natuurlik Suid-Afrikaanse besighede het dit nie vrygespring nie. So 'n plek soos 'n agribesigheid word natuurlik finansier deur 'n Netbank en 'n Absa en daai fondse het duurder geword en het minder geword. So 'n agrimaatskappy ons besluit het, maar waar gaan hy nou sy kapitaal spandeer? Gaan hy 'n nuwe John Deere agentskap in Duitsland gaan oopmaak of gaan hy geld aan 'n kliënt leen? Dit het agribesighede verplig om te kyk na kapitaalallokasie. So wat nou gebeur het is waar agribesighede in die verlede eintlik die amper 'n bankrol gespeel het vir die kliënt, het dit heeltemal verander. So hulle is nou verplig om eintlik sy omset te finansier. Dit kan nie meer eintlik net 'n chequeboek vir 'n kliënt wees nie, en dit kan ook net besigheid wees wat die nodige opbrengs lewer wat hy kan finansier. So ek dink waar ons die toekoms sien is dit gaan al meer in daai rigting beweeg, en al die agribesighede met die landbank wat met hom gebeur het, is verplig om in daai rigting te gaan. So daar gaan baie meer vennootskappe tussen agribesighede en banke in die toekoms wees.
En die agtergrond, or the background to that, is the fact that capital has always been kind of shy. Kapitaal is soos 'n kudu, hy wil weghardloop, hy wil jou nie hê nie. Hy probeer, hy's eintlik 'n lafhart. Yeah. But now capital's got a price that's higher than it was, and there's a scarcity element, and that becomes an important allocation decision. Yeah. It's not available as it was in the past.
Yeah. Dis presies, en ek weet, almal weet met COVID het die wêreld vol geld gepomp gewees, en dit het heeltemal verander. Dit het die koste die afgelope tyd, nie net die rentekoers nie, maar die marges het ook baie kleiner geword. Ons leen geld by 'n bank, so die marge by 'n bank is klein, maar omdat ons daai geld leen wat nog duurder is die marge by 'n landboumaatskappy net nog kleiner. So by 'n landboumaatskappy is lenings nie die kernbesigheid soos by 'n bank nie, dit is net 'n enabler vir die res van die besighede. So dis hoekom daar gaan definitief 'n verandering in die toekoms wees.
Antoine, you the John Deere, if anybody walks down, they are impressive mechanical pieces of steel, but that's only part of what you see. There's a massive amount of technology behind that piece of steel that's painted green. Tell us about that.
Yeah, thanks you. It's if you talk about John Deere 50 years ago, and you asked the company, what are you? And we would have said that we are a manufacturer of agricultural equipment. If you walk to anybody there now and you ask them, what are you? They will tell you we're a technology company. So the technology we split into two sections. The one is the technology on the machines itself, and that's technology in how the power is being generated in the tractor, for instance. So we want to make it efficient, we want to make it fuel efficient, we want to make sure that the right amount of power is being generated for the application of the equipment. So there's a lot of technology, and also in the materials that we use to build it. So a lot of technology goes into the physical equipment. But the more important part of it is the technology that we use to make this equipment work efficiently and effectively, and to gather information from those machines. So part of what we're doing is we're automating a lot. We're trying to take human error out of operations. You will see the gas machine there. That's a total autonomous spraying machine. And that's a lot of technology that we use to improve the efficiency of the equipment that we manufacture. We also gather a huge amount of data from those sensors and all of the applications that's being done. So a lot of technology and development goes into how we gather that data. So if you look at the machine as it is now, it's actually more like a computer on wheels. And it operates very much the same. I think that the computer generating power on a piece of equipment like a tractor If you compare that to the equipment or the computers that were used during the moon landing, it's actually more powerful in our machines than what you would have found in a spaceship. So very high technology equipment.
But then your platform that farmers use, that platform gets information from the producer. Talk about that.
Yeah, so the platform that we use is basically what operates the machine and what tells the machine what to do. And it also gives us then information back. So the producer will tell the machine, it will give it some input data about the equipment, about the farm, and about the kind of operations that they want to do, and the sizes of their farms. And then the machine itself will go and determine what's the most appropriate speeds that you need to use, what's the application that you need to do. It will identify, in the case of sprayers like us, it will identify exactly what you need to spray there, how much you need to spray on that specific, like wheat or the trees that you're spraying. So from the input data that you provided, it will take that and it will calculate the most appropriate ways for you to apply that. I think what's very important is the data that you get out of it. The equipment will give you a whole bunch of data related to your specific farm. So, for instance, you can track exactly what your machine is busy doing at the moment, how efficient it is running. It will track you what it has done over the last hour or two, whatever you want to ask it to do. And it will even tell you what kind of operations busy with. Are you busy plowing, planting, spraying, whatever. And it will give you a bunch of data then that is used to go and get a formula that you will input for your next operation that you're going to do. And a good example is during harvesting, we get information about yields.
What you're yielding while you're harvesting,
Yes.
you get real-time information as the harvester moves along.
Exactly. So during, if you look at a map of your farm, you will see on that piece of land that you're busy with exactly where your high potential, high yields were, and where the areas are that's not producing that well. So if you take that data and you take for your next cycle, you take soil samples and you're going to determine what the soil quality is in that field. You can then go and do exactly apply with your fertilizer, for instance, where you will fertilize the areas that need it more. You will fertilize those more than the areas that it's not really producing or does not have that potential yet.
Now, let me just ask you a quick question on that. Who owns the data?
So the data, there's two sets of data. The first is owned by John Deere, which is the machine data. And the
Temperature, oil pressure,
exactly.
those things.
The second part is the customer's data. So all of the data that John referred to and Aubrey referred to that's used to do risk analysis is owned by our customers. It's their data.
On your platform?
On our platform, yes.
Right. Verena, I'm going to bring you in here in terms of data and the ownership of data. Just give us the principal background from a legal perspective.
Sure. Theo, so if I can put it this way, data, there are two broad areas in which data can be protected or will be legally protected. And the first is the area of privacy, where we want to protect the integrity of data, so you don't want data to be misappropriated or misused. That would be where POPIA, for instance, comes in and protects your personal information. The other area is where the data is proprietary, and it's more closer to what we are discussing now. And when I say proprietary, that's more than just I own it. It is protected through some other form of ownership, which could either be that the data is confidential, and the proprietor of the confidentiality over that protects the data, or it could be proprietary under one of the forms of intellectual property rights. Now, broadly speaking, the owner of an intellectual property right is entitled to exclusivity. So the right that protects that data is exclusively owned by someone, which directly translates into the ability to commercially exploit the data, and then to prevent any third party from exploiting that data. So the question that arises over who owns the data becomes a factual one. Under intellectual property rights, you have to be able, what's important to understand, it's not because data exists that it is protected. It's not protected per se. You have to be able to bring it into one of the categories of IP rights. And it is then in the format in which it exists that it is protected and owned. So it becomes a factual question. You sort of have to look at it, case-by-case basis in terms of how was the material that is protected by the IP right, how was it created, by whom was it created, and then we determine ownership from there. It's quite interesting to me to hear the comments because you have a user inputting data, and then you have a machine sort of exporting data from there to the user's benefit, and it makes sense to have an arrangement in place to have that user own the data, but it would not necessarily legally be the case that is so. It will very much depend on the facts and sort of what arrangements were in place around the creation of the data in the first place and the technology that creates or put out the data.
Now, why I want to take the conversation from that point onwards is it'll be incredibly beneficial for John, for Nedbank, to exactly know the quality of that farming operation from a risk point of view. Should that data be shared with John?
I think if everyone in the value chain understands the benefit, then it only makes sense. It's like you're creating almost an open license environment, where I create something and I put it out into public under no license or license free, but on the condition that where that material is used and created, developed, adapted further, the end result would similarly be put back into public domain under no license or license free, as we put it. And that's just under the understanding that everyone benefits. So everyone here should benefit, me inputting data and then receiving what I imagine is very valuable data back from that, but that others in the value chain can also benefit from that data so that it allows the sharing of that data on the understanding that, I may have my turn again where I similarly benefit from the collation of other data. So it sort of comes full circle in my view.
Well, interesting, because I think the end result is the more data that's available from a financial point of view, the better informed decision one can make. Aubrey, John touched on it. The areas where the current financial system from the banks, where they fall short, which areas is either where there's opportunities or where it is almost impossible to get normal commercial funding in place?
Yeah, so I think as a bank you've got one or two options. You can either do what we call intuitive lending, which means it's a case by case. So we go and we sit down and we ask for all the information, evaluate it, identify the risk, or you can put it in a project or a program. I think John spoke about the new era farmers, and the problem is once again back to data. So I might be a new era farmer and myself and John might transact, but there's nowhere that data is captured. If that data is captured, it's independent, it's known, it's trustworthy, then all of a sudden there's one of the risks that's mitigated. I could see what John produced the previous years, the quantum, and even when you anonymize and you start to measure against each other, it's very valuable because some farmers are very good at production. New era farmers, they're very good at producing. And as soon as you have enough data, you can actually say that there's... So I think, that some of the opportunities is to develop programs that allows you to test and learn, to test some of the new technologies. And I'm not sure if Antoine is prepared to share some of the programs in a Kenya environment, but it's new thinking, it's using the value chain, it's using the data to come to a decision. I think one of the difficulties for a bank, and I think it links to your intro theory, is around, we are a controlled environment, the prudential authority is looking at us, and as soon as you start, taking a risk and there's a write-off, that attracts a lot of attention and something different. So that's some of the things that I think that we need to just, clarify at a point to say, you know what, there is a need for new finance, new models, and it might come initially with some risk, but allow us the opportunity to test and learn.
Antoine, you were noted there in terms of Kenya. Do you have a bit of background on that?
Yeah, so I think for us, we work across Africa, and the rest of Africa does not necessarily have the commercial or the level of commercial farmers that we see in South Africa. So we deal a lot more with new era farmers across Africa, and we had to find ways to finance them, to help them to get the latest technology onto their farms. So we started a project, one of them specifically is in Kenya, where we testing new technology on very low spec, low end equipment that can produce the same amount of data that we have in one of our more expensive machines. And the kind of data that we're talking about here is things like yield data, like operations, the areas planted, what operation, number of seed, and then yield data from that. And the idea is to the point to supply these two gentlemen with information that will allow them to build a history on a customer that does not have the balance sheet history that you would see on a big commercial farmer, and to be able to make projections for the coming year based on a really good set of data that's available. We're even testing now a financial package that we built onto our platform where all of this data is fed into and automatically this starts generating a cash flow for you. And it pulls information from buyers and also from input providers. I think the big key comes into the ownership of data, and for that purpose we do have quite a number of agreements that we put in place with our producers and our partners about the sharing of data, and we want to make sure that we cover ourselves and our customers and our partners as far as we can with permission to share data. And the very interesting thing is in a couple of years that we're busy with this now, we've never had one customer or partner that come back and does not want to share the data with us, because they can all see that value, and it comes back to the point to say that there's a mutual benefit for everybody out of this. So we can develop enough information to supply our financiers with a risk management tool instead of a risk. Well, it also becomes a risk mitigant if you can manage it properly. Everybody benefits out of that, and that's what we're busy with at the moment.
John, there's two elements that I take out of what you said in this conversation. First of all, data, but also the operator, moving towards the quality of the operator, the jockey in the old terms.
Yep.
Now you made a passing comment that property, or at least some kind of right to use.
Yes.
Just explain what the current thinking around that is, because if I look at the previous discussion we had this morning, there is a massive challenge in terms of large parts of farmers, traditional farmers, not owning the property.
Yeah.
Just talk a bit about that.
Yeah, so if I look at it, the conventional approach would be that unless we've got the farm property as security, we're unable to extend finance to you. So that's old school stuff, and I think we've already moved away from that a lot. But where the data becomes so important, especially in your annual crop production, then it may not be as important to have longer term leases or long-term security of tenure, because that's an annual crop production cycle. And while you can argue that the farm is never up to speed in 1 year and there's continual investment in a farm, it's easier in a working capital environment or a production loan environment to look short term. You're almost looking 1 year to the next, and obviously this type of data supports that. Where it becomes a lot more complicated in your longer term lending. So that's where there's investment into the property, long-term crops, citrus crops, pecans, macadamias, whatever, where there's such a long lag time. And therefore, if you're looking at the financial modeling, which is going to tell you that a pecan nut farm is going to break even in year 11, you've got to take a longer term view, and that's part and parcel of agriculture. But if you don't have security of tenure, what do you do when you get to year 8 and now the lease has been cancelled? So I think that principle about having access to the land for the period of the loan funding or in the life cycle of the crop that you're looking to finance is really important. The other thing I do want to mention at this point, and I kind of made a point about business risk and financial risk. I think that in dealing with the business risk, a lot of this data can certainly assist with that. And whether we get consent from our client to then access the data from John Deere, or whether the client provides us with us, that helps with the business risk, okay, and understanding the business and the repayment ability. The financial risk is and if I look at Aubrey, this is a discussion we've been having with government for some time, is how do we reduce the financial risk and the cost of capital? And many of these cases, we're talking about new business models, new approaches. The business case is not yet sorted, you know. As much as we'd like to think that it's now easier to lend money, it's not. But what we need to do is provide access to funding which allows people to migrate from maybe grant funding or combination of grant and sort of interest-bearing debt through to a commercial funding going forward, which is largely on interest-bearing debt. And therefore, you've now proved yourself. It's almost like a stepping stone. And that's why I think the blended finance scheme has such a vital role to play, because it allows us to really establish that history or track record. Is this business case sound? And then can we take people forward and migrate them off grant funding, which government only has certain resources as well.
And then move to commercial terms.
100% over time, you know, and not a big bang approach, because I think that is too risky, and it's probably unfair on all parties to have this expectation that if we lend a whole lot of money in, there's an interest component, there's a repayment ability of capital. It now fails after year one. What do we do? You know, do we now recall the loan, which is not in the best interest? So I think some of those older models of the Agri Credit Board and that have a role to play. But certainly in the modern day environment, I think the blended finance scheme, and again, government is just another partner, along with John Deere and Senvest and so on. So that to me is critical in how we tackle this going forward. The other point around the data, and even with our commercial farmers, I think from a credit decision process, we are using that. It's not as though we're not using it, we're using it as part of the credit decision process. So when we're testing farmers around your adoption of your technology, your mitigation of risk, they then bring all this to the table. I see some excellent benchmarking. Source BI is one good example. Their benchmarking analysis is really, really good.
And that assists you.
And that assists us, because a farmer comes and he says, okay, I've got this benchmarking from Source BI in this case. They mainly in tree crops, so citrus and avos and macadamias and so on. And there's a wealth of information. Now, we would obviously feed that into our risk process. The one part that's missing a bit for me, and that helps us decide, because we're looking at business risk, we're looking at the jockey, as you said. So what does this jockey employ in terms of mitigating risk? And we feed this into our risk decision process. Happy days. And then we've got security if all else falls down. But the other part going forward, and sustainability is very much part of this discussion, is how do we, as banks, evolve and move beyond looking backwards and in the rearview mirror? And even if we've got better data, how do we start to take a forward-looking view to say, this farming business is building resilience, and in this case, climate resilience, but you could argue just resilience in general. And how do we then feed that into our modeling process? Because that's not quite clear yet. It's in our decision process to say, tick, 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 this farmer's moving in the right direction. On all accounts, he should be more sustainable. But how do we benefit the risk rating model? And this requires intervention with the Reserve Bank and so on. So it's not just, you know, something we fix on the back end. However, if we can build that in to suggest that following climate-smart agricultural practices builds resilience, therefore it should reduce the risk of the farmer going forward, is how do we build that into our modeling? But that's work in progress, and I'm no doubt all the banks are focusing on that.
And their technology will play a massive role.
Yes, it will. It will play a role. And the other complication is that if you talk sustainability, and I noted Theo Boscher from AgViz said, they're looking at a sustainability index of sorts, because so how do you get your arms around the sustainability? You know, what goes into an index, for example? But that's work in progress.
Because the question of capital allocation, do you measure that against a required rate of return, a hurdle rate? How do you go about, and how do you then measure risk around that.
Ja, so dis presies wat ons doen. Ons bereken maar ons geweegde gemiddelde koste van kapitaal, soos 'n rekenmeester dit sal sê, en dan met die finansiering, want soos 'n boer wat finansier word, betaal nie binne 'n maand terug 'n paaiement nie. Meeste van hulle gaan eers aan die einde van die seisoen 9 maande later of 8 maande later terugbetaal, en dan as jy 'n produk verkoop wat jy 5% marge op het, dan gaan daai som net nie sin maak nie. Hy gaan net nie die hurdle rate maak nie. So dit is presies wat ons doen. Ons doen die hurdle rates om kyk watter van die produkte wat ons verkoop, en die produk wat nie daar val nie, moet dan maar kontant verkoop word. Dit is die opsie of hy moet gefinansier word deur die bank. So ek dink dit is die realiteit, en dis hoekom ek dink wat die data gedeelte betref, die agrimaatskappy het 'n klomp van die data. Hulle het die John Deere data, hulle het die insette wat gekoop is, wat se tipe saad is geplant, wat is die opbrengste wat gekry is. So daai data, en dis die toekoms wat ek sien, dat die banke en al die maatskappye gaan saamwerk op die finansiering om te sê, maar hier is die finansiering wat ons gaan doen vir hierdie boer, en dis op daai basis, en dit is die data wat ons gebruik het om dit te ontleed.
All right, I'm going to allow for a few questions and then closing comments. I see the screen here is red in front of me, which says time's up. But let's ignore that for a while. Any questions in the audience? There is a roving mic. Any questions from the audience? Any questions? Yes.
The issue of expropriation without compensation, we never hear conversation from government side to say, okay, if that law is going to be introduced, that farmers got finance on it, what's going to happen to that finance if that farm falls under that? I mean, what are the banks saying about that?
Okay, any other question? All right, thank you very much for the question. I'm going to add to that question and put two ways on that question. My first portion, and this is specifically, John, to you and to Aubrey. The whole issue of expropriation without compensation, how does it feature in your credit process? Is it a risk you look at it? If you look at it, how do you look at it? And then the question is, if something like that were to become policy as legislation is now, where there is an option of a zero compensation, what's the legal view around that? So, John, would you kick it off?
Yeah, I certainly can. And just bearing in mind, this does not only apply to sort of agricultural property.
No.
It's a much broader definition of property. The first port of call around this is that the changes to Section 25 were not carried. Okay, yeah. So that did not go through. And I think most of us agree that they were not necessary, and the expropriation bill as it was allowed for that. However, there is a review of the expropriation bill, and I think it's about, I know we've given input through BASA. Just to answer that question directly, and this is the bad news, and I wish Aubrey had sort of delivered the bad news, but where there is a loan to a bank and it's underpinned by a bond, even if you are compensated at zero, you're still liable for payment of the bond to the bank. So that's a separate contract, okay? And that did cause a lot of unhappiness, as you would expect. It feels unfair, but there is a contract that if there's no compensation, the loan is still repayable to the bank. All right. So there's more to it than that, and you can get into the fairness and that around it, but that's the harsh reality, I suppose. If we look at the expropriation bill as it is, it does target specific areas of where compensation is not payable. And I think that's where there's still a matter of interpretation or greyness, if you want to call it that. Because I think until that gets tested in court, we might well not fully understand what those definitions mean. I think that just a few other comments around this and an expropriation bill. We do have to be cautious around the message it is sending out into the external environment. The investment into agriculture is really important for the sector going forward. And while we've seen farmers invest into their farms over the last few years, and we've seen banks invest into agriculture, if we look at the BASA investment into agriculture, whether it's banks and farmers, has been quite staggering in the last 4 or 5 years. So that's a positive indication that agriculture has a future. However, if if we feel that the expropriation bill is starting to work against property rights, that could deter investment into agriculture, both by farmers as well as other investors. And so we're watching that closely.
Thank you, Theo. I'll keep it short. So I think John is 100% spot on. Now, we did provide our feedback. At the moment, it is at a level where we say it would need to go to a court of law to be tested, and then we will adjust according to that. There's clear reasons why there's expropriation without compensation. That by itself was not concerning to us, and I think John spoke around the past 3 years, the investment from commercial banks into agri. So from a risk appetite, we're not at a point where we're saying we're cutting back. It's still invest, and it's still, extremely important for the government. I mean, I think government also listed on a number of occasions, food security, economic principles. So where it is at the moment, it's watch and see, and adjust then when something happens. But at the moment, we're fairly comfortable where it is.
Any other questions? Yes, at the back.
Yeah.
Oh, yeah. Front, yeah.
Sorry. Andile Buthelezi from SAFTA. My question is, I'm trying to get my head around what this new era farmer is, and I'm hoping that we'll get some sort of explanation what that is. But maybe just talking from a black farmer perspective, what are the new models that the banks and the other institutions are looking at beyond just the blended finance? Because those conversations have been going on for years. We see it with the DFIs that they already started doing it, but we don't understand what is holding the commercial banks from partaking. And can we also just shy away from models where the banks want to work with commodity organizations which have previously excluded us as black farmers?
Other question, can we take the other one at the back as well? And then we can...
Thank you very much. I would like to know an observation in general. If you look at agricultural finance, the debt-to-asset ratio has really increased year to year as many farmers make use of debt to either expand the farming operations or grow it in some sense, or maybe just keep up to date with increasing costs. How do you walk the line as a financing institution between investing, in the farming enterprise, adding value to it, managing risk, but also sometimes walking the line where you sometimes actively have to give advice to say, listen, when I make the calculations, maybe this part of your farming enterprise isn't doing too well, or maybe this one is doing well as well. So to what extent do you take an active approach in steering the outcome to help manage those risks, especially where your debt is increasing and maybe the jockey, isn't as trustworthy as a businessman, maybe as he is as a farmer, just for interest's sake?
Thank you very much. There's two very important questions. Thank you very much for both these questions. Who would like to start with the first question? Aubrey?
Thanks, John. So I think very, very valid. I think we spoke around value chain financing and making sure that the value chain can de-risk, some of the components that traditionally, if there's no asset base or no security, there's also, other security forms. There's some government guarantees that we use. So it's around, just being creative around how do you, mitigate your risk in this value chain. And that means that, other people in the value chain also take a risk. It can't only be banks. I think Theo spoke around the responsibility towards depositors. It's their money that we're working with. And then I think just, talking about a credit policy, I think banks' credit policies is designed to allow a level of ability to absorb setbacks. So we never sail that close to, debt ratios that can tip it over. When we get close to that, there's a secret or a unit within the banks called business support, where they try and manage with the client, around getting it to acceptable levels.
John?
Yeah, just to maybe add to the first response. I mean, I'm fully cognizant of the fact that, well, there's two things. One is new era farmers, emerging farmers, there's so many definitions, and I think it is murky water there, but there are a lot of black commercial farmers which are doing well and making their own way. So that's the first thing to acknowledge. It's not just, it's sort of only white successful and unsuccessful black. I think that's old news, and we must step away from that. I do think, though, that proving the repayment ability over time is really important. So those downturns, and we know in export horticulture last year had a severe downturn. And I think, unfortunately, unless you've got really good reserves, and we talk about the debt-to-asset ratio, it's really difficult to survive a downturn like that. And therefore, who carries the can, So I think these are things that we need to sort out, but the value chain finance, in my view, is certainly has a big role to play, along with the blended finance scheme. And just to say on that, I don't think it's the banks that are holding it up. There's ongoing discussions with the department, and we as eager to be involved, and I speak for all the banks, to be involved in blended finance. The sooner we can do that, the better. But that's only a very small part of the solution, I guess, because the funds, again, are limited, Just to the gentleman at the back, I think we've got a really sophisticated client, and you have this engagement. That's a very high-level engagement. I'm fully understanding that even in those discussions, the strategic discussions about the growth, the pace of growth, what happens when you hit a wobble, So how does the bank come to the party? How does the client come to the party? Or is it only expected that the bank needs to now fork out? So those discussions up front with the client, either at review when he's undertaking a new capital expenditure program, is vital to work through with the client. And some have structures in place and management and teams that can assist you with that, others not. And I feel it is a responsibility of the banks to ask those hard questions. And is your gearing getting out of kilter?
And it's perfectly within your right for credit to say to somebody, no, that's not going to work.
Oh yes. In fact, that's our responsibility. And sometimes that initial discussion does lead to a solution because, and what we prefer is not just a no, and there's no reasons given. It's a no because we're worried about, you've got to understand where you are in the cycle, and if you hit a downturn, what happens, etc. And I think it leads to solutions because if you're challenging your clients as well as respectfully dealing with the hard questions, it often leads to solutions and a much better understanding. And that's what we want. And I'm talking more the commercial agriculture. I think how we have that same thinking throughout our sort of agricultural finance is important because it's as important to the small guy as the big guy. What happens when you hit a wobble, for example. So there's lots of work to be done. And one of my frustrations, I suppose, all of ours, is I've been in agricultural finance for a long time, and the transformation, we haven't cracked that yet. I'll be brutally honest. And I'm hoping that technology is going to help, but it's not a silver bullet.
Antoine, from an advice point of view, if you sell one of those big pieces of technology, those computers on the big wheels, what's the advice portion?
Yeah, I think there's two sides of it. There's the usage advice that you will give to a customer that uses it to make sure you do it properly, but also when the buying decision needs to be made, we also play a role there, and specifically in my business, in John Financial, we try to engage the customer about what's the best way to actually buy this machine and how do you finance that. And our advice that we give him is very much linked to his business cycle that he's in. And we see that when you are, and I think it also relates to the whole question about your debt equity. It also depends on what stage of your business cycle you are in. But if you're growing very rapidly, the use of foreign capital through financing with a mixture of own capital brought in can actually help you to grow your business a lot quicker, and to get that technology onto your farm that will help you to just step a lot better, more forward. So So I think the advice portion is very important, and I think a lot of our customers, be it small or large, miss that because they just come in and they want to buy and they want to get out onto the farm as quickly as possible. The discussion should be more with, where are you in your business? What do you want to do with this? How is this going to help you? And how can we help you to do it as cost effectively as possible?
Thank you very much. They gave us additional time, which is nearly we run out as well. I'm going to end up with asking the panels almost a closing comment, and I'm going to ask from your point of view, if you look at advising a client about his or her data, what would be the elements that somebody should look at if you were to contract or enter into agreement with somebody that collates your data and is going to use that data? What should you be looking at in your agreement with that party?
I think foremost for me would be clarity. I think it would be critical to understand exactly what is being collated, to be comfortable that which you are providing, is not subject to something like confidentiality, and I would like to keep it confidential, that I am willing to provide that and understand what exactly will be done with it. How will it be used? Because especially in an environment where it is used by the third party to the third party's commercial benefit as opposed to your own or others. So that would be the big thing for me, understanding why, what is being collated, why, how will it be used, and then sort of ensuring you understand a big picture and deciding from there whether you're comfortable or not. I think it's a complicated issue, and it definitely calls for contractual sort of management and arrangement. But both ends should be clear on what the playing field is and what the limitations are or not.
John, Aubrey, I'm going to ask you as bankers, as Nedbank and Absa, the same question. If people apply for credit, some of the areas where you believe people could elaborate more, and some areas where they just make mistakes. What are some of the elements that you believe people should share more detailed with either Nedbank or Absa?
Okay, well, let me kick off. So I think the first thing for me is that finance does really unlock a lot of opportunity. I mean, and that's the way I see it. It's not just the money; it's everything else that goes with it. And so that's important. But when people approach us about a loan, for example, and bearing in mind we don't only do lending, so that's another important thing to do. The whole transactional solutions, the value-added solutions, etc. Some of our partnerships are key in terms of that whole basket. So I don't want to get too caught up on the lending, but let me focus there for now. Is you've got to understand the risk in your business, and I think maybe where an individual, their understanding of risk is maybe not as deep as other clients. It's our responsibility to help them in that. But in understanding the risk of the business and working through that with the client, in terms of how does that impact on the repayment ability of the loan, okay? Because money is expensive and interest-bearing debt comes with a cost. And you do need to allow for variations to that plan, whether they're external shocks or whether it's an internal issue in your business. You've got to understand how you deal with that, because it doesn't help going into a relationship with a client and then in month 2 you're on a different page, and then it's no good. So the level of understanding is really important. Understanding the risk drivers in your business, and then working through that with the bank to say, this is how I'm mitigating the risk. This is the risk in my business. How do you, Mr. Bank, also suggest that we look at mitigating the risk? So whether it's insurance or whether it's getting value chain players in, whether it's offtake agreements, etc., etc. In the sugar industry, for example, I mean, a cession of crop income is meaningful. It's more meaningful in sugar than some other enterprises because the sugar cane has to go to the mill. So I think in that sense, a cession over income in sugar is maybe preferable to other enterprises where, like a vegetable farmer, for example. So it really is important for a person applying for finance to understand their business, to discuss the risk with us, and then for us to put a solution in place that solves for that.
And not necessarily a product off a shelf. It's a solution.
No, it's a solution, and I take the point that there may be different solutions. So some of them, depending on the volume business. So if it's a smaller, in the small business game, yes, it's less customized, but it's still applicable for that client and at the price at the right level. So it's not a customized solution at every single level. Okay, but certainly I think whatever solution the banks are putting on the table must solve for that client. You know,
Aubrey.
So I think it's important that there's different categories of clients, and therefore there's different capacities in that businesses to address certain things. So I think for us it's very important. We have relationship banking with a number of specialists across the country. If you don't know, reach out, talk to them. Let's make it a relationship. I think that's important that we talk around that. And the factor economy, we would like to see how you think around when stuff starts going wrong, your strategy from a medium to a longer term. So to try and understand how you think around your business, how adaptable or flexible you are.
But it comes down to a relationship.
It comes down to the relationship.
That means there's a trust sharing between the parties.
Exactly. And I think my last comment is, I think ABSA, as the other commercial banks, we open for business. We understand it's extremely important, this sector, on numerous, different places in the economy, employment, social, economy. So we open for business, use the relationship talk.
Antoine, I'm going to slightly change the question in your case. The decision of buying, investing in mechanization, the kind of mechanization we talk about. What's the factors that any buyer should look at specifically if that tractor or harvester needs to be financed? What should he or she take into consideration?
I think the first most important one is the fit. What do I need in my business? If I need to buy a 200 horsepower machine, why should I buy a 300 or a 400 horsepower machine?
Because that's the newest machine.
Yeah, it is, but you also get a very new one in 200. I think the biggest thing is make sure that the equipment fit what you are going to do. Make sure that you sweat it properly. One of the problems, if you buy those big machines and you've got a small farm, it sits there. It doesn't really work for you. Make sure that the decision that you make when you apply for finance is the right decision on what financing you're applying for. Is it possible to do a lease or a rental for machines that's not going to be used extensively during the year? And then I think the last one is what are you going to do with the technology there? It doesn't help you to buy the latest, highest technology and you don't utilize it. Otherwise, you're just throwing money in the water. Make sure that you utilize that what you buy to the utmost on your farm.
Because you're going to have the last word. You talk about capital allocation, and then you talk about your cost of funding and the return. How should a farmer approach that question?
Ek dink hulle moet dit presies dieselfde manier na kyk. So as hy sy John Deere gaan koop en dit kos hom R6 miljoen vir 'n nuwe trekker, gaan hy die nodige opbrengs kry. Gaan hy die 10%, die R600,000 se opbrengs ekstra kry deur dit te doen, deur die ou een te vervang, hoe die instandhouding gelyk voorheen. So ek dink presies soos 'n landboubesigheid en 'n bank doen presies dieselfde, presies dieselfde wyse moet die boer die somme maak.
Baie dankie. Thank you very much for my panel. Thank you for the guests. I think everybody made a valuable contribution, and just as a closing point, I want to thank, there's 3 members here that represent some of the sponsors, John from Nedbank, Antoine from John Deere, and indirectly Vickers from Senvest. Thank you very much. Thank you, Aubrey, and thank you, Werina. Thank you for the discussion. Thanks, guys.
Yeah, thank you.